Welcome back to Wealth and Wisdom. If you've been following along, we've covered a lot about stock evaluation, diversification, and risk management. But today, we're diving into one of the most important principles of investing: long-term investing. In this video, we're going to explore why patience is key, how to adopt a long-term mindset, and how it can lead to more successful outcomes over time. Let's get into it. Before we talk about why long-term investing is so important, let's first define it. Long-term investing refers to the strategy of buying and holding investments, such as stocks, bonds, or real estate for an extended period, usually 5 years or longer. Rather than trying to time the market or chase short-term gains, long-term investors focus on the overall growth of their investments over time. This means they're less concerned with the daily fluctuations in stock prices or market conditions. Instead, they aim to benefit from compound growth, dividends, and the natural rise in value of their investments as companies and economies grow. The key here is patience, understanding that wealth building through investing takes time and doesn't happen overnight. One of the biggest reasons long-term investing works is because of compound interest. Compound interest is often referred to as the eighth wonder of the world, and for good reason. It's when the returns you earn on your investments start earning their own returns. For example, if you invest $1,000 and earn 7% interest per year, your investment grows to $1,070 after the first year. The following year, you'll earn 7% on the new total of $1,070. Not just your initial $1,000. Over time, this effect compounds, causing your investment to grow exponentially. The longer you allow your money to grow, the more powerful the effect of compounding becomes. This is why the earlier you start investing for the long term, the better the results you'll see in the future. In the short term, the stock market can be unpredictable. Prices fluctuate due to daily news, economic reports, or even market sentiment. This can lead to emotions like fear and greed, which may cause you to make impulsive decisions. For example, during a market downturn, many investors panic and sell off their stocks, locking in losses. Or, when the market is doing well, some investors jump in without properly analyzing the fundamentals, hoping to catch the latest hot stock. Long-term investing helps you avoid short-term noise. Instead of reacting to every market shift, you stay focused on your long-term financial goals and let the market recover from temporary dips. By doing this, you give yourself a better chance of seeing overall growth rather than getting caught up in market volatility. Your time horizon plays a significant role in how you approach investing. The longer your time horizon, the more you can ride out market ups and downs. For instance, if you're investing for retirement in 30 years, a temporary drop in the stock market today is less concerning because you have decades to recover and benefit from compounding. On the flip side, if you're investing for a goal in the near future, say buying a house in a few years, you might want to adjust your portfolio to include more stable investments, such as bonds, which are less volatile in the short term. So, knowing your time horizon helps you make smarter investment decisions that align with your goals. Long-term investors typically focus on growth stocks, index funds, and ETFs that will likely appreciate over time, while shorter-term investors might lean toward more conservative options. One of the most powerful benefits of long-term investing is that it reduces risk. While short-term investors may buy and sell quickly to capitalize on market fluctuations, long-term investors are less concerned with the day-to-day changes in stock prices. Think about it. Over long periods, the stock market has tended to rise more than it has fallen. Despite the market crashing several times throughout history, whether due to recessions, pandemics, or financial crises, the long-term trend has been upward. By staying invested, you avoid locking in losses during downturns and instead benefit from the eventual recovery. Let's take a look at some historical data. The S&P 500, which represents the broad U.S. stock market, has had an average annual return of about 7 to 10% over the long term, factoring in inflation. The longer you stay invested, the less likely you are to experience permanent loss. Over 20, 30, or 50 years, a diversified portfolio of stocks is highly likely to recover from any short-term dips. Another great strategy for long-term investors is dollar-cost averaging, or DCA. This strategy involves investing a fixed amount of money at regular intervals, regardless of the market conditions. For example, you might invest $100 every month into an index fund, even if the market is up or down. The beauty of DCA is that it helps you avoid trying to time the market, which is extremely difficult and can lead to mistakes. By consistently investing over time, you'll buy more shares when the prices are low and fewer shares when the prices are high. Over the long term, this evens out your cost of buying and helps you build wealth steadily. So instead of focusing on market timing, focus on building consistency. The more regularly you invest, the more likely you are to benefit from compounding and market growth. To wrap things up, long-term investing is one of the best strategies for building wealth over time. It allows you to harness the power of compound interest, stay focused on your goals, and ride out short-term market volatility. By investing for the long term, you can reduce risk, avoid emotional decision-making, and take advantage of market growth. Remember, it's not about timing the market, it's about time in the market. So stay patient, stay consistent, and let your investments work for you. Thanks for tuning in to Wealth and Wisdom. If you enjoyed this video, don't forget to like, subscribe, and hit the notification bell so you never miss an update. In our next video, we'll be discussing tax-efficient investing, how to minimize taxes and keep more of your hard-earned money. Leave any questions or thoughts in the comments below. I always love hearing from you. Until next time, stay wise, stay patient, and keep investing.